Good afternoon. My name is Tim Boroughs, and I'm the Chief Investment Officer of the Chubb Group. Joining me this afternoon are Rob Kapito, President of BlackRock, and Charles Hatami, Global Head of BlackRock's Financial Institutions Group and Financial Markets Advisory. Today, we will discuss BlackRock's newly released 10th Annual Global Insurance Report, which leverages survey results from over 350 insurers globally. We're going to explore themes driving momentum within the insurance industry, including risk appetite and how sustainability and technology have become embedded in the investment process. So with that, I'd like to start off with a question for Rob. And Rob, particularly given the events of the last few days, it's clear that we're not returning to the same world that we were before the pandemic. What do you think will be the lasting implications of the COVID-19 across global economies and markets? And what trends do you think are here to stay?
Well, thank you, Tim, and thank you to the International Insurance Society for having us. I want to take it in a direction that may seem unusual to you, but what trend I see is I see a lot of mental anxiety amongst all of the people that are coming back to work. And the reason for that is in our generation, when we were looking for happiness, we got a job, we got a good income from that job, and that made us happy. And today, people believe they could get a job, they believe that their income will be good, and they want to be happy. So 1 and 2 doesn't equal 3 anymore. So there's a lot of mental anxiety about number 3, being happy. And we've all been running and running. And when you run, you don't see everything that clearly because you're running in a quick direction. And then when you start to walk, you start to see things that you may not have seen when you're running. And then when you actually stop and go slower, things become even clearer, and it gives you a lot of time to reflect on life, reflect on your job, reflect on your family. And now we're trying to get people to walk again and to jog again. And I think it's a process that we're all going to have to go through. And I believe that people are going to need a little time to get through that process. So this is a trend that I see. It's going to take some time. So between the people trend, the process that we have to go through, and finally the technology trend, where technology has been sped up, just like we are talking today on Zoom, and I call it the Zoom where it happens instead of the room where it happens. When we go back to that, I just think it's going to take some time, and it's going to take some time for us to get to know each other again, and to motivate our people to get back into a process that will all be good for us going forward.
I think all solid points, and certainly at Chubb, we're really seeing all of that in as we return to work here, across, and obviously we're operating in 52 countries, so we're seeing it globally. Rob, while I got you, I want to turn to the economy. It's a real focus here in the investment area at Chubb, but the Fed and the central banks in general, we believe, are facing a difficult and challenging environment as they unwind historic and, in our minds, excessive monetary stimulus. How do you expect financial markets to react in this environment? And from a secular standpoint, and related to this, are we headed toward a higher core rate of inflation in the U.S.?
Well, I follow cash, as you know. And right now there's over 40 trillion of cash that's earning zero and in some place negative. That cash has to be invested at some period of time for people to be able to retire in dignity. And there are not enough assets for that 40 trillion to be invested in when interest rates are so low, and there's not that many places to go except equities and then alternatives. So until we see that 40 trillion start to move, to me, rates are going to be low for longer. The equity markets are going to have a bid to it, and will move to multiples that maybe you and I are not used to, but others are getting used to pretty quickly. And alternatives, meaning private equity and real estate and other assets, I think are going to continue to attract money to be able to find yield that all of our clients desperately need. And we're going to have inflation. And you may not notice it today, but I wore something special for this group today. And it's a button that says WIN on it. And I got this button in 1975. I kept it since high school. And what it stands for some of you watching this, is whip inflation now. Because inflation became the biggest problem, if you recall, in the country then. And there is no way that we are not going to see increased inflation. So food prices are going up. Why are food prices going to go up? Because especially with this infrastructure bill that's being passed, people that are on the farms are going to move to higher paying construction jobs. So on the farms, you are not only going to be able to pay workers, you're not even going to be able to find workers. So that will show its head in not only wage inflation, but food prices are going to have to go up. And then, of course, energy prices, we all know, are going to go up. So when you take food, energy, and wages, and you have pressure on all three of those, we're going to see inflation. And I don't think enough people are thinking about inflation. And today, you can't just go out and buy tips in the marketplace. And what performs well? What's a good inflation hedge? It's large cap value stocks, global value stocks, real estate, all the things that already have a very strong bid in it. So it's going to be uncomfortable to take your inflation hedge in that way, but it's going to be the only way that you can go. So a lot of our clients are concerned about inflation. They're worried about how long this is going to take for the Fed to be able to come in and get rates to a level that makes sense to attract this 40 trillion into fixed income, which is necessary. And they're all looking right now for inflation hedges, and we're busy trying to come up with opportunities for them without increasing the risk of their portfolios.
Right. One of the things that we're focused on, Rob, related to this is how the Fed and central banks in general are going to respond to the environment, let's say throughout 22 and into 23. And I already believe that they're going to be challenged by their messaging, where inflation, over the near term is going to be very strong. And yet I think that if they take a slow approach to this, they're going to have to rely on a forecast that it's going to unwind and come down. And so I think they're going to be challenged by that. And from our perspective, the idea of rates being at zero, overnight rates being at zero, and all this excess liquidity in the system, we think that policy is generally misplaced. And with growth and inflation as strong as they are, when you have conditions which are very similar to what you'd see in wartime circumstances. So I think that it's for investors in general, and certainly for global bond investors like ourselves, that's a real point of focus for us.
I would agree.
Yeah. Now, if we could just for a moment now turn to the insurance survey report. And I have a question for Charles. BlackRock recently released, this is the 10th anniversary of the Global Insurance Report. Can you briefly explain what this report is and how BlackRock uses the insights, and what trends stand out from the report?
Sure, Tim. So the BlackRock Global Insurance Report provides really insights into the thinking of global insurance industry senior leaders. As you mentioned, this year's survey includes the views of 362 senior executives across 26 markets, including yourself. Taken together, these companies represent over $27 trillion of assets, encompassing approximately 2/3 of the sector. So their report complements the global findings with regional results, comments from insurance CIOs, and insights from BlackRock experts as well. As you mentioned, this year marks the report's 10th anniversary, so it's a special one for us. And the themes that we see are really threefold. The first one is insurers have a near unanimous focus on climate risk as investment risk. This is remarkable because even in the context that you guys described and the higher focus on sustainable investment in the industry, also reflecting BlackRock's views on climate risk and a net zero transition, we really see that climate risk has become a given for insurers and investors in the world. In addition to climate risk, there are two other themes that the report really underlines. The first one, as you both mentioned, risk appetite is going to increase. And the investment into private assets in particular, we see it as something that will explode in the next 18 months to 2 years. The second one is insurers are using technology to transform their businesses, both from a digitization and the customer acquisition and management, but also from a risk management and investment management perspective.
Now, you mentioned that one of the key findings in this year's global insurance report is that insurers look to increase their risk appetite in their search for yield. I did notice that when I read through the report, and I'm always nervous about standing in a line. Can you provide any additional information on this?
Sure. Important stat, we saw that 60% of the respondents and the insurers plan to increase their investment risk exposure in general over the next 2 years, and including into privates. This represents the highest level since BlackRock started tracking the information in 2015. The large increase is not just a matter of preference, but as you both mentioned, a necessity given the continued low interest rate environment and the relative return of higher fixed income and alternative or private assets relative to treasuries. It's very important to note that as insurers look to expand their risk appetite, we see diversification, both from an asset class perspective, but also geography, like China example, as a real driver for portfolio allocation. And liquidity management is also becoming much more prominent. So there's a barbell strategy where they invest in more private assets and risk assets, but also maintain liquidity and cash, obviously as a key priority. Notably, by 2023, we see that private market allocations will really reach 14% of insurers' total portfolios. To give you an idea, currently we stand at 11% only. This alone would represent an $800 billion increase in private market allocations in the next 2 years. From an SAA perspective, no insurer expects to have an allocation of less than 5% for the total portfolio by 2023. To compare, that's 32% currently have an allocation under 5%. And we also expect 2/3 to have an allocation above 10%. So that's quite remarkable.
And Rob, you mentioned it, you touched on it earlier in your comments, but where are you seeing investment opportunities in today's markets, specifically for insurance companies as we go forward?
The private equity space is one that people certainly have to be looking at. With the entire market structure is changing of companies that are public versus private. There are certainly opportunities in the technology space, in the healthcare space, as the market structure of those industry changes quite dramatically. So we think there are opportunities in that. We also think there are opportunities in infrastructure, because infrastructure provides long duration securities that have an impact. And people want to make investments that have an impact and that are longer term in nature, that they can see, feel, touch, watch. And of course, they're much more stable long-term investments than hedge funds are. So we see alternatives becoming less alternative. And then I think another overlooked area that we have to get back into is real estate. And it depends real estate in what areas of the world, what type of structures in real estate, and where those opportunities are. So I think there are just a number, but they're all put in this category called alternatives. And that's something that we're going to continue to build out on behalf of our clients.
Maybe I might lend a little perspective from where our strategy focus is now here at Chubb. And I basically agree with the results of the survey and your comments, Rob. I mean, with a little twist and turn. I mean, we're a global property and casualty company, which means that we have to be fairly conservative in our investment philosophy, which translated in your language, we're a global bond investor. And then we add risk at the margin where we can get additional return. And we focused on doing that, by the way, in 2019, which has really served us well over the last 20 months in terms of having more total returning strategies in our portfolio. But I would characterize this as, like many other fixed income investors, we're frustrated and we're repressed, right? We've been repressed for a long time. And we don't feel that bonds are an effective diversifier of risk assets. So I guess our current strategy is really focused on how asset classes are going to behave in a rising rate environment. It may take a while, but we think that negative real yields across the entire fixed income spectrum are an unsustainable condition, and you're going to see the term structure and short rates rise. So I think that you got to really keep your eye on that. We want to, in terms of strategy choices, we're maintaining a conservative duration and a very high quality basis in our credit selection. Where we can, we're shifting from fixed to floating, and trying to identify cash flowing assets that offer sustainable returns and some protection from inflation. And you mentioned real estate and infrastructure. That's an area of focus for us. And we've been obviously doing long-term private equity investing that have sustainable returns and are cash flowing. It's hard to say in our mind in a tail event if inflation does get out of control and the economy rolls and we've got this virus under control. So we have looked at strategies to protect our assets in a tail event, even though that's not our base case. And I do believe that if rates do rise, we're going to see, I think, correlations rise among asset classes and probably a dispersion of returns based on the interplay of profits and inflations and so forth. So it's a pretty difficult environment. We're in a great place here at Chubb in that we have exceedingly strong cash flow. The insurance markets are very strong. So we're coming in every day on the investment side, trying not to do something stupid. You know what I mean? And it's just a difficult environment with yields this low. Charles, the report also highlighted insurers' growing focus on sustainability. What are your thoughts in terms of this finding?
Sure. A few stats, first of all. I think the three relevant ones that we saw in the report. 42% of respondents confirmed that they turned down an investment opportunity over the past 12 months due to ESG concerns. That could be because of reporting issues, that could be because they don't have transparency, or simply because the investments are not carbon efficient from their perspective. They also said that they're twice more likely to say environmental risk is one of the top macro concerns that they were in 2015. And then finally, 95%, almost unanimously, of the executives confirmed that climate risk will have a significant impact on portfolio construction over the next 2 years. And so, just to react to what you mentioned, marrying that with the investment in private assets in a rising environment creates a really interesting and complex environment for us and for our clients to manage. The need to respond to the prospect of really unmanageable physical risk for a PNC insurer, for example, understanding the science and the economics and the regulations that goes with it, it's really not just about values and norms. I think the opportunity and successful navigation of these risks and how we transition to a clean economy is actually good for this country, for the world, and for our clients. As asset owners, I think insurers will have a really important role to play in the transition to net zero. You know, you're investors, you own real estate, and you have to insure these assets across the world. And effectively, the views that we have is that we share the mandate with asset managers and insurers towards net zero goals. We also see that asset managers in general can seek to achieve net zero goals on behalf of asset client owners to direct engagement with portfolio companies and security selection, which obviously turns the influence and the cost of capital for these companies. We always think that going from brown assets to green asset will not happen in one shot, but you'll go from brown assets to less brown and across the board and all across to green ones. And that attention and that focus, the participation in that transition will reduce the cost of capital for these companies that try. Insurers in general expect to increase the allocation to investments by 30% over the 2 years, as I said. We see the increase in the risk appetite and to sustainable assets across a couple of areas. First of all, impact allocations, meaning allocations with the sustainable investment objectives. We see that as an increase, including in private markets. For example, we've seen over the past 2 years a continued appetite by insurers to allocate to BlackRock's renewable strategies. To be more specific, the AUM in the strategies for insurers alone has doubled over the past 2 years. That's significant. The other one is that insurers want to optimize traditional core fixed income and equity strategies with a ESG building blocks lens in both active and passive investment strategies. I think, given the new rules in New York in particular, there's an opportunity to start including ETFs that have a sustainable angle to build better, as building blocks of better fixed income portfolios. And we see that insurers are also going to start using standard equity benchmarks with ESG weighted components that take into account specific insurers' policies and commitments. So these are all kind of meaningful, and I think the combination of all that is for us, we really believe that insurers are going to potentially start thinking about how to transfer their back books and invest that more into sustainable assets. The question is, will there also be clients and partners for BlackRock and for asset managers that will really start getting their hands dirty to go to help in this transition on a more activist basis? So again, this could be a really interesting private equity conversation. Or could we have a product that helps green some of these assets and make them more carbon efficient effectively?
Well, let me piggyback on that, Tim, because a couple of the terms we've used will seem to simply increase risk of portfolios. We know from being around 11 financial crises that things that are not correlated, when the market does go the wrong way, everything is correlated. So just increasing the risk is not the way to do it. And we can offset some of that in the bond area with private credit. And private credit is sort of in between what you were talking about, bonds and private equity, where there are really good companies across the globe that may not have access to the capital markets, the public capital markets, that we see that we've been through different cycles, have been able to earn between a 9 and a 12% return. So there's ways to be in the bond market, but not increase the risk as far as you might in private equity. The second thing is that for insurance companies is the need to use the longevity for your benefit. And many are looking at short-term investments that are not going to do as well as using that longevity for you. And then the third thing, which is really important, just really important to focus on, is this whole energy transition. we have to do it right. We have to have the data so that we actually know what we're investing in are really the right things to get us where we want to go. But it is not about divesting, and we can't let the media hype take us in that direction. It's about investing in the transition. This is going to be a huge transition. It's going to happen. We're moving to new energy sources. And quite frankly, it'll probably be the current energy companies that are going to lead in this transition to the new energy. So we have to work on investing, not divesting. We have to keep our heads on straight. We have to use data. At BlackRock, we bought 2 companies that specifically provide data on climate so that we can actually have a proof that this is actually helping, create some standards so that we all are going in a direction that we can all agree is the right direction, and then prove it at the end of the day and actually be part of this solution so that we can also earn a good return as we're doing it and sponsor the companies that are making the transition. And the transition is going to take some time. So we can't just penalize the companies that are currently providing energy sources to us that we desperately need to make the transition.
Here at Chubb, we're simpatico with everything you just mentioned. We're like others. I don't want to say we're struggling, but we're really focused on how to integrate the transition and sustainability into the portfolio process, where it's not so much a matter of exclusion and meeting rules, but where can you be opportunistic and proactive in terms of investing for that sector. Before we get to the last question, at Chubb, obviously we've invested heavily in data and analytics for catastrophic perils such as wildfire, floods, hurricanes. And this is going to help us understand the risk to our customers and how changing frequency and severity of perils could impact our insurance aggregations. We're aware of the impact on both sides of the balance sheet and periodically we conduct exercises to aggregate underwriting and investments in terms of its impact to our capital. A good example of that is when we looked at our exposures on the insurance side for cat loss along the East Coast, and then what our muni exposure was and how we wanted to balance all that up. We think that we're at the early stages of those analytics, and that it's going to require a lot more work. And as you said, Rob, you have to become, we all have to become clearer in terms of how we define, those sources of risk in order to manage more properly. So, Charles, the report also made a link between sustainability and technology. What did you really glean from that?
Exactly as you mentioned, Tim. I think this is a key component of how we will achieve net zero. At BlackRock, as Rob mentioned, we have heavily invested into how we model transition risk across all sectors, how we model physical risk, and how we model net zero, which is really scenario evaluation. And we see it in the report, across alternatives, fixed income, and all the other asset classes. We really have an opportunity for investors to take a whole portfolio view when addressing sustainability. And it starts with being able to measure it and provide appropriate reporting. At BlackRock, we've seen that this pickup across all asset classes, including in our iShares with the launch of the new ESG IG corporate ETF that we have. It's unanimous. So the survey thinks that 60% of insurers look to increase spending on technology over the next 2 years. Digitization is playing an important role in meeting insurers' net zero ambitions on one side, but then 35% of respondents also confirmed that they're looking to increase investments in technology that integrate climate risk and metrics, as you mentioned, Tim, to us is a clear sign that the analytics for transition-ready investments are a top priority for insurers over the years ahead. But as I mentioned, the modeling aspect of it is really complicated. When you think about transition risk, that requires really understanding scenarios of the future state of the global economy, new policies, new technology, regulation, geopolitical dynamics, etc. And that's something that we're heavily investing on to help our clients. Finally, I would say measuring the economic impact associated with these changes also requires an analysis and how transition ready these companies are. When Rob describes how we invest in them and how we effectively reward companies that are trying, we need to be able to measure that. And I think, between asset owners like yourselves and the insurance aspect of what you do, you will be able to invest in that, and our clients really want to make this more transparent. I would say the combination of the sector and company-specific analysis is a very important one. From our perspective, that will be key to understand, to have a full picture and being able to translate that into the portfolio as well.
Well, this has been insightful for me, you guys. Do either of you have any closing comments you'd like to share with everyone?
Well, I would just say that we look forward to working in partnership with the insurance industry. I don't think we all have to spend endless amounts of money trying to come up with various themes. This is something we can work on together to create some standards that we can measure, and then we can provide the performance and the results that everybody needs together. So I do think this is going to require more partnership, more meetings like this, where we can come to some agreements as to how we can move forward, create some rules of engagement, and then work together to make sure that we do the right thing for our employees, our shareholders, and our clients.
So Tim, Rob, I'd like to thank you for joining us today. It's been a great conversation. I also like to thank the International Insurance Society for hosting us. Thank you so much.
Well, I look forward to seeing you in person soon.
Thank you so much, Tim.
Thank you, Tim.